Today is Monday, January 8th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Started with the grain markets this morning, Mark. With a slew of USDA data due out Friday, have you noticed any historical price tendencies in the January reports?
Yeah, this is one of the largest USDA reports of the year with final production estimates from last year's corn and soybean crops, stock estimates from December 1st, updates on South American production, potential revisions to both U.S. and global balance sheets, and finally USDA's first glimpse into the 2024 winter wheat acres. Historically, there has been a bit of a bullish tilt in this January report. Since 2000, spot corn futures have closed higher 14 out of the 24 years, or 58% of the time. That figures up a little higher in soybeans at 63% and up to 70% for spot wheat. If you look out a week beyond the report, the higher trade in corn and soybeans is back to about 60% of the time. However, in wheat, it backs off all the way to 50%. So 12 years higher and 12 years it was lower 1 week after the report.
Everybody, one of the things that we'll be looking at is the ending stocks. What are your estimates for U.S. production and ending stocks?
I'm leaning a little bit lower for both U.S. corn and soybean production from last year. And corn, I've got production pegged at 15,190,000,000. That's with an average yield of 174.5 bushels an acre. This production estimate, that's down 44 million bushels from the USDA estimate in November. However, still a record large crop here in the U.S. On the demand side of the equation, the only change I've got from the USDA balance sheet is a 25 million bushel increase to corn used in the processing of ethanol. I'm probably in a minority on this one as margins have collapsed here recently. However, in the first 4 months of the 23-24 marketing year, I've got usage up 7% to date so far. So in the USDA's forecast is only a 3% increase. So I think the higher usage forecast is justified. And that leaves ending stocks at 2,060,000,000, down 71 million from the USDA, but still a 5-year high. In beans, I've got production at 4,115,000,000. That's down 14 million from the last USDA estimate. My yield's at 47.9 bushels an acre, just down a few tenths. And on the demand side, I think we're going to start seeing the USDA get a little more aggressive in cutting the export figures here. I've got them lowering at 25 million bushels this month to 1,730,000,000, and that would be a 5-year low with ending stocks at 256 million bushels.
And Mark, South America, what do you know about the crops down there?
Well, for weeks now, I've really been touting lower in Brazil, higher in Argentina. So I'm going to stay with that. In soybeans, I've got Brazil down 5 million metric tons to 156 million metric tons. This being partially offset by a 2 million metric ton increase to Argentina. In corn, I think they're going to hold Argentina steady for now at 55 million metric tons. However, I do have an upward bias moving forward as weather has improved significantly. In Brazil, I see the USDA lowering production there 2 million metric tons to 127 million metric tons, given the drought conditions impacting their first corn crop. A lot of growing season ahead with the harvesting of soybeans followed up by planting of the second crop corn.
And looking at the financial markets, how about a rundown on this week's potentially market moving reports?
Okay, well, first of all, on Tuesday, we'll have the December National Federation of Independent Business Small Business Optimism Index. That's guessed at 90.6. Then on Thursday, we'll have the December CPI guessed at up 0.2% and jobless claims at 209,000. Then on Friday, we'll have the December PPI guessed at up 0.2%. So of all these reports, it's the inflation numbers that are most likely to have the most market impact, especially if they do come in away from the guesses.
And on Friday, the dollar index saw what technicians call an outside trading day. What is that, and what's the significance of it?
Well, the outside day basically is a higher high from the previous day and a lower low, but it was really not the one-day reversal because we did close right in the middle of the range, and in fact, very close to unchanged from the previous day. But what it does do is suggest that there is a lot of volatility. I know that there was a lot of volume on that day. So it implies a lot of indecision and a lot of confusion. Quite often a large trading range day comes at highs and lows. So of course on Friday we had the employment numbers. So to me, this is an indication that the dollar may be topping off of this week and a half advance that we have seen. And it still looks like the main trend is lower for the dollar index, especially since the Fed will probably be the first of the major central banks to be cutting interest rates later this year.
Alan, we still have two wars going on out there, some uncertainty, a U.S. election. However, the gold market has come under pressure recently, so really not seeing any flight to quality buying right now in the gold market. What's your take in the gold market right now?
So that is correct. There has not been much flight to quality buying in the gold, but the dominant influence has still been the interest rate outlook. And what has happened in the last week or so is a feeling that the Fed will not be so aggressive in cutting interest rates this year. Late last year, there was the thought that the Fed would be cutting rates quite a few times. And I think traders came to the realization that there may not be the 6 rate cuts that's some of the financial futures markets had predicted, maybe closer to just the 3 rate cuts that Fed officials have discussed. So a less dovish Fed has put some pressure on futures, but even though there is likely to be a less aggressive and a less accommodative Fed, interest rates are still likely to decline this year. And I think longer term, that is a recipe for higher prices for the gold market.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.